2013 has been a good year for investors, particularly if your money has been in shares. Stock markets had the wind in their sails at the start of the year and, despite storms in the second and third quarters, largely held on to their gains. In the UK, the FTSE 100 index of the biggest companies on the London Stock Exchange started at 5,897. It peaked at 6,840 at the end of May, narrowly missing the all-time high set back in 2000. However, by the end of November, it had hit 6,650. That's a rise of nearly 13%, and if you add in the dividends the companies paid shareholders, that's a total return of 17%. The FTSE 250 index, which measures the performance of shares in medium-sized companies, did even better with a 28% total return. The FTSE Small Cap Index, which tracks smaller companies on the exchange, is up nearly 30%. Put those together and you get the FTSE All Share. The index representing the vast majority of the UK stock market grew nearly 19% this year. So that's good news for UK shares or equities. What about bonds, the other major asset class for investors? Bonds are the tradable loans issued by governments and companies when they borrow money. Here, a 20-year rally in bonds looks to be over as investors look for the better returns from equities. UK government bonds, or gilts, are down nearly 3% this year, having become very expensive as a result of a huge buying spree by the Bank of England. Corporate bonds, which offer slightly higher returns, are down a similar amount on average. The advance of shares and retreat of bonds has come as the UK economy has done better than expected. It grew faster than any other developed Western nation in the third quarter. But the big investment story of the year has been the collapse in the price of gold, which has lost around a quarter of its value since the start of the year. Gold is a safe haven investment when markets are in trouble. Investors piled into the precious metal during the financial crisis. With economic confidence slowly returning, there's been less need for gold's defences. Gold was also sought after as an alternative currency, as central banks such as the Bank of England and the US Federal Reserve, and most recently the Bank of Japan, have flooded their economies with a vast amount of new pounds, dollars and yen. That wave of money has lifted many boats across the world, with the US leading the way up 28%, followed closely by Europe and Japan. The really big question of the year was how much longer central banks can continue to print money. Since the early summer, the headwind against stock markets has been the speculation around when the US Fed would start to reduce or taper its stimulus. The prospect of fewer dollars looking for a home, combined with nagging doubts about China's economy, hit emerging markets. The strength of the pound further weakened the returns from emerging markets. From the perspective of a British investor, emerging markets fell 2% in 2013. Individual countries did worse. Brazil slid 13% in sterling terms, India 9% and Russia 3%. A recovery in China's stock market meant the Shanghai index ended November near where it started the year. The slowdown in China's previously roaring economy meant a difficult time for commodities markets as the world's second largest economy consumed fewer raw materials. So what's it all mean for the average investor? A good indicator is to look at the performance of managed funds, which invest mainly in shares but also dabble in bonds and other asset classes. In the first 11 months of the year, they were up an average of nearly 14%, taking their 5-year gains to 75%. An excellent result and one that puts investors in a good mood as they wait to see whether 2014 will be so buoyant.